Welcome back. On today's video, we're talking about 3 of my biggest regrets from investing. Let's jump right in. My first investing experience is back in the 1990s, and it was buying a stock called MCI WorldCom. WorldCom was one of the long distance providers. They provided long distance service to people who had a landline phone because cell phones weren't really a thing, at least weren't very popular. And you had to have a long distance provider. So you would have like US West or Quest or someone for your home phone that you plug into a wall like everyone's seen. And then you would have to have a long distance provider to connect you to long distance services. You could go through your normal provider, but you would pay a lot more, or you could go through a company like MCI WorldCom who would bill you monthly for all the long distance that you use. It was kind of a pretty good gig, and there's a whole industry behind it that we're not going to talk about right now. And this stock was having some trouble, so I bought the stock not really knowing anything about it, and realized that it soon became one of the biggest scandals in investing history. So it talks about, if you go to Investopedia, you can see the different pieces here and what happened and how WorldCom actually went into bankruptcy. When I bought the stock, I naively thought that if they go into bankruptcy, well, I'm a shareholder. They'll be getting rid of unsecured debt. They will not be getting rid of shares because I own a piece of the company. Right? Wrong. Actually, companies can bankrupt out their shares, their shareholders, and come back stronger and more financially viable for the owners of the company. So, lesson learned there was, just because you're owner of a company's shares in the stock market does not protect you from bankruptcy and does not protect you from scandals that the owners may do. A big learning experience. Fortunately, it wasn't a lot of money at the time, but it was a lesson learned. The next one was accredited home lenders. Now, Accredited was a subprime mortgage lender. They were one of the better run lenders. They were not the highest volume, and generally that was because they watched their lending standards a little bit better than some of the other companies out there, at least in my experience. They had lower delinquency and whatnot. And my lesson learned from this one was accredited home lenders was running fine, but then the credit crisis hit. And what happened in the credit crisis was a lot of the lenders that had been lending were not lending well. There was a lot of mortgage loans went delinquent. There's a whole different backstory behind this we're not going to have time to go into. But what really bit a lot of these subprime lenders was not the delinquencies. It was the mark-to-market accounting rules. And what mark-to-market meant was, if you had, let's just say, if you're selling a house and all of the homes around it are selling for 50% of what the home sold for a year, you have to, as a bank, mark the asset value down to 50% of what you may be holding it on your books at. And then you have to have reserve requirements in the banking industry. So some of the subprime lenders were very bad operators and should have gone out of business. Some of them were caught up in this mark-to-market scandal, and not a scandal, but the mark-to-market guidelines, where you had to take all of the assets, the loans that you had on your books, and you had to mark them down to what you could sell it for today. Even if the loan's performing, even if the loan's doing well, it doesn't matter. It's whatever you can sell those at today. So you may have a loan that's a $100,000 loan, but because it's labeled as a subprime loan, it doesn't matter if it's performing, paying on time or not. That $100,000 loan gets marked down to, in some instances, like $30,000. So now, because these lenders are leveraging debt, they're borrowing money to lend money, they are upside down on these loans, and technically they become bankrupt. That's high level. Obviously, there's a little lot more into it. But what we're seeing here is Accredited was one of the companies that realized this was going on, and they agreed to sell themselves. So in this particular instance, they decided to sell themselves for $15.10 per share. Keep in mind that Accredited stock was tapping up over $60 a share not terribly long before this. So as an investor, that hurt. Accredited came out and mentioned to their shareholders that they had agreed to sell themselves for $15.10 a share, but they needed their investors to pledge their shares, which means basically agree to it, lock up the shares until the transaction goes through. At the time, I thought this was a good idea because many of these lenders were just going out of business. Trusting the management, we said, sure, let's go ahead and tie up our shares. Well, at $15.10 a share, that was one thing. However, Lone Star Funds was the company that agreed to do it, and you can see in this article they agreed to a $400 million buyout. Lone Star came back and renegotiated the deal to get down to a $310 million buyout. So anyone that had pledged their shares is not able to sell them, which they could have done at that $15.10 a share price, but instead Lone Star came back in and tried to renegotiate for $8.50 a share. They ended up settling for $11.75 per share. However, every shareholder took a haircut on the shares that they had committed. They could have just sold the shares, but that was one of the investing lessons I learned. If you are in a buyout situation like this and there's a good offer, you like the offer, don't lock up your shares, just sell them. That way you have access to that capital. This took another 6-8 months, if memory serves. This was back in the 2007 timeframe. But just sell your shares. That way you have the use of capital, take the loss, and move on. That was lesson number 2. Lesson number 3 was PayPal stock. But PayPal, as everyone should know now, is a payment provider. What many people may not know is 10, 15 years ago, PayPal was about the only game in town. Not many companies accepted Visa over the internet. Not many companies had these direct bank debit options. PayPal was kind of the only game in town. And PayPal was, of course, the eBay preferred and almost, I think it was the only eBay option at the time. So PayPal had this monopoly in the market, and they were running very high. You can see that this is actually a 1-year look back. If we go back to the max, you can see PayPal had a parabolic run starting in about 2020. Anyone know what happened in 2020? COVID, of course. And then it ran from about $92 a share up to the peak of over $300 a share. I want to say it was about $308 if I can get it to settle there. Yep, $308.53 a share. As COVID tapered off, there was a few things happening, but a lot of different providers were entering the market. Every credit card company provided their online portal where people could pay direct. Debit cards, of course, were prevalent and still are. And people started to realize that PayPal didn't have the monopoly that they had once before. And the price cratered all the way down to in the 70s, and I believe it got much lower than that. Yeah, we're in the 50s here. So PayPal stock became a very much a losing proposition for people that could have sold it for $300 a share, were then sitting in the low 50s. Now, PayPal has started coming back. If you look at the PE ratio, it's actually a reasonable PE ratio for a fintech stock, and that gets into the whole stock market thesis and how you analyze stocks. But at a 20% or a 20 PE ratio, that's fairly low for fintech. So PayPal now has normalized, but the question that we have to ask ourselves is, how viable is PayPal? With all of the other options now, they're not a luxury, they're not a fixed market that has a corner on the market, they're not a monopoly, they're a commodity. And anyone can replace them, and people have a number of different options when they go to PayPal. So PayPal is right now, in my opinion, kind of struggling to figure out what they want to get to, what they want to be, how they're going to compete in the market. They've rolled out some crypto options. But the biggest lesson to me on PayPal was when you get up to these highs, especially when you see a parabolic run like this that just goes straight up and the only catalyst is a one-time event that is going to be overcome, take your win. Somewhere, anywhere in this range up here, start selling off your stock in chunks. Don't sell it all at once, of course, but take some of the wins and expect some downside, because there's always whatever goes up, unless there is something that keeps it there, unless there's some sort of a catalyst that makes that the only stock, you have to start wondering if it's going to come down. So those are my 3 investing issues that I've seen, the 3 things that I would regret most out of any of my other investments. I hope this has been helpful to you. If it has, give us a like down below. If you'd like to see more content like this, consider subscribing to the channel. And if you know someone this may help, please do share. Thanks for being here. We'll see you on the next one.